In this week's Property Insider video, Dr. Andrew Wilson and I discuss some of the possible unintended consequences of APRA's forthcoming macro-prudential controls. Are they going to slow the property markets down, or are they going to create a mini boom? Who's going to be hurt and who's going to benefit from it? And we discuss lots more property news, including the latest unemployment data, loans data, and what's happening in our property markets around Australia. If you want to keep up to date with what's happening in our property markets, please subscribe to this YouTube channel and click the little bell icon so we can notify you every time a new show comes out. We're into the last quarter of the year now, and what a year it's been. For many, it's a year we'd rather forget, even though very few of us ever will. So much has happened and so much has changed in our life. Well, in some cases, not much has really happened as we've been stuck at home. However, for homeowners and property investors, it's going to be a year that the value of their properties will possibly increase by 20%. And in some cases, their properties are going to earn more in capital growth than the owners will from their day jobs. But is it all going to come to an end soon? Or are the forecast macro-prudential controls from APRA, maybe they're going to create a mini boom over the next couple of months? Last week, the Council of Financial Regulators, that club of 4 major financial watchdogs, showed concerns about the increasing levels of home lending in the first half of this year. In particular, they signalled their concern about the number of mortgages taken out at more than 6 times the borrower's income. Now, in last week's Property Insider chat, Dr. Andrew Wilson gave his views on why there isn't a case at present for interference in our housing markets. If you haven't watched that conversation, check it out at propertyinsiders.info, which will take you to our YouTube channel. Thousands and thousands of viewers watched that particular discussion. But the world of property is moving on so quickly, and so much has happened even in the last week alone, that I wanted to discuss the possible outcomes of the proposed macro-prudential controls. What would they be doing? Will they slow the market down? Will they actually create a mini boom? And who are they going to hurt? Of course, there's lots of other property news to discuss this week, so I look forward to my regular chat with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market. Hi, Andrew.
Yeah, good day, Michael, and nice to see that we had a little bit of a response to our previous video.
Well, in that chat last week, we explained how even though property prices have increased by around 20% this year, they were flat over the previous couple of years since 2017. So the market really was only playing catch up, meaning over this cycle, average capital growth wasn't exceptional. And you noted clearly that the market's working its way through the cycle with lack of affordability naturally slowing down capital growth over the last few months. But the media keeps asking, who's going to fix this Australian housing affordability issue? The Reserve Bank's not going to get involved. Its operating instruction is set on full employment and price stability, even though it recognises that the ultra-cheap money's boosting, it's accelerating the property cycle. But Philip Lowe said, well, what's the opposite? If they raise interest rates and see lower house prices, it would mean fewer jobs, lower wages growth. So the Council of Financial Regulators is now concerned about the amount of this high debt to income borrowing, and it's asked APRA for some potential measures. But Andrew, are they going to respond in a cautious way? Are they going to have a measured response, or what's going to happen? Are we going to get unintended consequences?
Yeah, sort of these stories seem to have their own momentum, Michael. There's the old saying, let's not let the truth get in the way of a good story. And I think that's what's happening at the moment. I'm not quite sure why we continue to have this analysis based on incomes versus the house prices. What we're really talking about, or the volume of housing loans, is the level of repayment that we have in terms of our income. And we know that we actually have a lower proportion now on average that we're paying off in our housing loans than we've had for quite some time. And of course, that's why we're not seeing issues to do with mortgage stress, arrears, or mortgage defaults. They're quite low, they remain low. And maybe those higher levels of savings do reflect the fact that we are paying a lower proportion of our income in our mortgages. So that gives us the capacity to save more. But again, those that questionably are in the position of creating these policies or changing policies don't seem to understand the essence of our housing market dynamic. And as I said, the reason we have high debt versus incomes is because we've had such a dramatic cut in interest rates over the last 3 or 4 years. But we had some, again, data last week, Michael, that validated the issue regarding why would we need to control the housing market. Again, we've seen house price growth, although still positive, has come back again. We've now seen 3 consecutive months of lower house price growth. It's clearly trending downwards. This is an issue, as you said, of affordability, that buyers can no longer afford to keep paying higher prices for properties because they don't have the incomes growth or a lower interest rate to push prices up at the rate they have been pushed up recently. So that's just the natural stabiliser at work. As long as banks maintain their rigid lending conditions, which they are, and they've been alerted that they must continue to do so, then we will see just the easing, what we are seeing now quite clearly. But it wasn't focused, as you suggested, in the media again on the growth this year, which of course is quite spectacular, without acknowledging that growth, if taken over the last 4 years, is quite modest. But let's not let the truth get in the way of a good story, particularly if it's a scary story. As I said, the trend for prices growth is clearly easing. It has been easing now since June. The other significant data that we had out last week, Michael, was the ABS data for August home loans, and that really crashed. No surprise, because it reflected the lockdowns in New South Wales and Victoria. Lending was down 4.3% over the month of August. And that's the sharpest decline we've had since May last year, Michael, when that was also a period of lockdown. So obviously the lockdowns impede the capacity to borrow, and that's why we've had a sharp decline. We have seen good news on lockdowns, on shutdown. Victoria has changed since August its regulations regarding property inspections. We have seen that market bouncing back over the past few weeks. Similarly, New South Wales has eased some of its restrictions generally, and we are starting to see an increase in activity there as well. So even though we had a sharp decline over August, we'll certainly get a bounce back now that we've had easing in restrictions. But I don't think we're going to see the bounce back to the level where it will ease those affordability constraints that are actually affecting the underlying growth of finance cycle. So, these things have been, it was the 3rd consecutive month of falling home loans. It's clear that when we look at owner-occupiers and first home buyers, that portion of the market peaked earlier in the year. In fact, first home buyer activity is down nearly 25% this year, or since the beginning of the year, Michael, but it still remains at above average levels. So first home buyers are still finding their way into the market at quite healthy numbers. It's just not at the near record numbers that we've had over the past year or so. The big interest in the data, which we have been discussing, was that even though owner-occupiers and first home buyers fell quite sharply over August, investors continued to rise, Michael. Despite all the lockdown issues, investor activity increased. And in fact, market share for investors now is the highest it's been since May 2018. It's still below average, but it's certainly catching up to those long-term average levels. And as you sort of intimated before, I think all this conversation regarding the possibility of intervention from our regulators, which is a good story, but that's about it, may actually encourage more investors to come into the market to avoid any possible tightening of lending conditions.
You're right, Andrew. We're already noticing investors in particular who are discretionary, they don't have to invest or buy or sell. They're wanting to get in early. It's creating another addition to the sense of FOMO. They want to get in before the changes are brought in. Now, just to clarify what you said about home loans, yes, they are decreasing, but we've got to remember that they're still considerably higher. They're 47% higher than last year. But if we look at what really created that higher debt to income ratio, as you say, first of all, it's lower interest rates. But the other bit is that the government has allowed first home buyers, because of its home builder scheme, the federal government's first home loan deposit scheme, individual state government incentives, it's allowed first home buyers to get into the market with very low deposits, to be more indebted than normal. But that's actually what the government wanted. All of a sudden, they're saying, hey, this wasn't any good. And of course, the low interest rates has allowed many established homeowners to upgrade their homes as well.
Yeah, but we're not seeing any issues with serviceability, Michael.
No, we're not.
Serviceability that's there. I mean, the issue with first home buyers has been the capacity to save a deposit, and that's been the big constraint. And with the first home buyer deposit scheme, which allows eligible first home buyers to purchase a house with just a 5% deposit, and the mortgage insurance is provided for them. But nonetheless, the issue is that they've got mortgage insurance. So they're actually, any issues are covered through mortgage insurance. So, and of course, they still have to meet the income requirements to service that 95% loan. I'm not sure, I can't understand why we don't get the depth of understanding of these issues, which to me, I don't seem to be terribly complex. And the supporting evidence, such as the level of defaults or arrears, just doesn't stand up in terms of there being any issues with problems with serviceability. And even when we had higher numbers of unemployed, Michael, we didn't see a shift that, as a result of COVID last year, restrictions, we didn't see a move away from the low levels of arrears or defaults in the mortgage market. So they're really good stories, but gee whiz, it doesn't really hold a lot of water.
Interestingly, the media and others are saying, what about this issue about affordability? How can first home buyers ever get in the market? Well, targeting debt to income ratios is going to have limited impact on the higher wealth households. They've often got multiple streams of income, but in my mind, it's going to affect lower income households, and particularly those purchasing for the first time.
Well, what I found amusing was, Michael, with all these issues of affordability, we've just come through one of the strongest periods for first home buyer activity in our history. In fact, it's the strongest period since 2008 and 2009, where we had our record period for first home buyer activity, courtesy of the Rudd government's first home buyer deposit boost scheme. We've had a similar result here. Hundreds of thousands of first home buyers have found their way into the market. Doesn't sound like they can't afford it to me. As I said, there's no over lending going on here. We know that. We're realising the great Australian dream. Those are realising the great Australian dream in near record numbers, and we're still above average in terms of first home buyer activity, and we have reached the peak of our price cycle in terms of prices growth. Now, we are seeing fewer first home buyers. That's a sign of the affordability constraints that are self-adjusting our market at the moment, Michael, which is a really good thing. And it was always tough to get into the housing market as a first home buyer. We all know that. And it's been because we've had lower prices generally over the past 4 years, like we said, average 4%. That has been part of what's allowed first home buyers to be able to get into the market. Now, obviously, prices growth now is so strong that it's squeezing them out, and that's what we would expect. Now, can't have everybody having the capacity, it'd be nice to be a homeowner, and that would only limit the aspiration for home ownership.
Good point.
But we cannot criticise affordability or home ownership over the last 12 to 18 months on the data quite clearly. And it's just a story that, once again, doesn't really hold water when you look at the facts.
Well, I don't think that story is going to go away anytime soon, Andrew. But if we look at other news, yes. Interestingly, building approvals rose in August. Despite the lockdowns, they rose 6.8%. Now, you can't just take 1 month's figures into account. And it's also interesting when you dig deeper and look at houses as opposed to apartments, because there is a shortage of apartments coming up in the medium-term future.
Yeah, how interesting, Michael. It was the apartment market that suffered the most with the APRA incursions in 2015. In fact, it was, in my opinion, a direct result in the collapse of apartment construction from 2015 was the restrictive lending practices that were foisted on investors. And that really was the end of the apartment boom. And of course, now it's very difficult to find development finance and to get development occurring for apartments. And apartments are the way in the future of most of our capital cities. And that's only going to create an undersupply. And we're already seeing some signs of that. And it hadn't been for the stopping of international migration, I think we'd be seeing even more issues to do with housing shortage, particularly apartments. So again, as you said earlier, Michael, beware the law of unintended consequences. And as you said, the latest data is promising, and it's good news for the economy on building approvals. We know they've fallen away because of the end of home builder. There's still plenty of demand there for new home construction. The issue is on the supply side, to the point of providing adequate planning and finance, particularly for medium and higher density, which we're just not seeing a significant revival in. Again, as I said, as a result of those issues and policies that were introduced, it really did crack that market.
The other news over the last week was that job vacancies fell. Now, they remain above pre-pandemic levels, but it's not surprising with the two biggest economies, New South Wales and Victoria, in lockdown, that people aren't looking to employ more people at the moment.
No, Michael, we've still got hard yards to go, and much will be revealed over coming months as to the impact of the Victorian and New South Wales lockdowns. We're coming from a stronger position, at least this time around, with lower unemployment and higher employment. But we all have already seen with the latest data, a lot have left the workforce that have given up looking for work. It has meant that our unemployment rates still look reasonable, but of course they're being affected by that lower participation rate. So it will be revealed over the next few months just the impact of lockdowns. And thankfully we are now moving back into a less restrictive environment. And we can hope that's not going to mean the same sort of issues that we had last year in terms of economic growth and unemployment.
We'll have to see how that works out. Now, it was an interesting weekend in the auction market, a tale of two cities. Sydney had a long weekend with its grand final, and Melbourne had the opposite, where all of a sudden people were able to inspect properties over the last couple of weeks, so more vendors put their homes on the market.
It was a really big weekend, just no sign of the market slowing down. In fact, there was notionally an acceleration of the market to begin October. Michael, we had fewer listings in Sydney. It is the Queen's Birthday long weekend holiday in New South Wales this weekend. And as you mentioned, they do have their rugby league grand final. That doesn't have a huge impact on the market, not as big an impact as Victoria, but still there were significantly fewer properties offered for auction, predictably, over the long weekend in Sydney. But we did see another increase in the clearance rate in Sydney, up over 85% now. We've had over a month of clearance rates at or above 85% in Sydney. Just no slowing down. Of course, fewer listings means fewer choices and more competition amongst buyers for available property. So no surprise the clearance rate increase. We also saw auction prices up quite steeply in Sydney as well, Michael, over the weekend. But Melbourne was, as you said, the opposite. We saw a big surge in listings in Melbourne. It's the highest number of listings since the lockdown. And of course, that was a bounce back from the grand final last week. The AFL grand final was always a distraction. We had low numbers of auctions in Melbourne last weekend, and that's bounced back. But Melbourne recorded its first 80% clearance rate since May. So that market, as you said, now with restrictions eased, is up and running again. We will see a bounce back in activity in the Melbourne market now that those restrictions are eased. We're seeing that clearly with other indicators. New listings and new sales are surging in Melbourne from a low base, but that market's now able to reactivate what was a strong market energy prior to lockdown. It's in catch-up mode still, so hopefully it'll be able to catch up without any more interferences. But the other smaller markets were also strong, Michael, really across the board, some very strong results there. And again, markets shrugging off lockdowns and getting on with the business. And there's still a lot of latent energy. We've spoken about an easing in the housing market cycle, but as you said, it's still very strong and it's still well ahead of where it was a year ago, and it still has some way to run. It's just not in fifth gear anymore, Michael. It's probably somewhere between third and fourth gear, but it's still pretty good news if you're looking to sell a property, because you're going to have plenty of interest in that particular proposition at the moment. Doesn't matter where you are, I think.
It sounds like while we're waiting to hear more about the reopenings of our state economies, what's going to happen with vaccination rates, what's going to happen with international tourism, nobody's waiting to see what's happening with the property market. We're getting in, so we're going to be chatting again in this channel once a week to keep everyone updated with what's happening. Thanks for your time, Andrew.
Thanks, Michael.